I'm always looking for under the radar stocks to buy, and this company has a market cap of just $13 billion, which is generally on the smaller side of companies that I invest in. It is one that not many people seem to be talking about, and the stock price is down 17% over the past year, which means we should take a closer look to see if it's possibly undervalued right now. And the company that we're going to be talking about in today's video and analyzing is Amcor, ticker symbol AMCR, and this is the 7th video in my subscriber suggested stock analysis series. So if you do have a particular stock that you want me to analyze, leave me a comment down below, or you can join my free Discord server and I'll add your stock to the list and analyze it in the future. Since Amcor is a little bit less well known, let's talk about what they do. Fundamentally, they are a global leader in developing and producing packaging for food, beverage, pharmaceutical, medical, home and personal care, and other products. So they're mainly based in Australia and the USA, but they do have facilities around the world, and they split the business into two segments. So the first segment is flexible segment, which just like it sounds, develops flexible packagings worldwide. And this segment accounts for about 76% of revenue, so about 3/4 of revenues there. And then the other segment is the rigid packaging segment, which is mainly based in the Americas, and that accounts for the remaining 24%, or about 1/4 of net sales and revenues. And as you might guess, Amcor is in a pretty big phase of change right now as they work towards their goal of having all packaging be recyclable, compostable, or reusable by 2025. And this goal is a big part of their current business and growth strategy moving into the future. So now we're going to talk a little bit about specifically how their business is performing. And we'll first do that by taking a look at their fiscal year 2023 results, which ended on June 30th of 2023. For the year, net sales were $14.7 billion, which was up about 1% from 2022, but those sales were about flat on a constant currency basis. And when we look at net income, these results do look somewhat positive, but the economic reality doesn't quite reflect that, and I'll explain here. So in 2022, they did have some restructuring charges of about $100 million that was related to the Russian business, which lowered their net income in 2022. And in then 2023, they recorded a pre-tax gain of over $200 million on the sale of their Russian business. So those kind of things skewed the numbers so that 2022 looked a little bit worse than it actually was, and 2023 looked a little bit better than it actually was. But on an operational basis, the business actually performed slightly worse in 2023 than in 2022, and that was largely due to demand softening and customer destocking in the second half of fiscal 2023. And management does think that those current issues will kind of remain for a short while, but they do see a return to earnings growth in the second half of fiscal 2024, and this is in line kind of with their fiscal 2024 outlook as it compares to fiscal 2023. So in fiscal 2023, their earnings per share was 70.5 cents, and they're expecting between 67 and 71 cents of earnings per share in fiscal year 2024. And going forward after that, their long-term trend and goal is to grow earnings at a high single-digit rate. And to understand their financial health, we can take a look at the balance sheet. So we can see that current assets are down a little bit from last year to about $5.3 billion. And likewise, current liabilities are down as well to $4.5 billion. And the good thing here is that current liabilities are significantly lower than current assets, meaning they have enough, cash and similar liquid assets on hand to pay off their short-term liabilities. And that's kind of the good part of the balance sheet. The bad part of the balance sheet, in my opinion, is the debt. So we can see they have a pretty small amount of short-term debt, but they do have $6.7 billion of long-term debt, which is a lot relatively speaking for their business. Right now, their net income is in the range of $1 billion. So that's really like 6 times the debt to net income, if we look at it that way, which is one way to look at it. Amcor, from the management perspective, they kind of frame the debt a little bit differently. They talk about net debt of $6 billion, which is accurate, and their EBITDA of $2 billion, which is also accurate. And they compare those to get a ratio of 3 to 1, which is what they say is in line with their expectations. So I guess my thoughts on that is that even the 3-to-1 ratio isn't really all that great. Something like 2-to-1 would be a lot better in my opinion. And then also, I don't really see why they are excluding depreciation and amortization in this ratio. I think it makes sense to exclude interest and taxes because that kind of gives us a sense of the operational earnings when we just look at earnings before interest and taxes. But to exclude depreciation and amortization doesn't make sense because those are real expenses that, you know, even though they're not a cash expense, they kind of represent the cash expense that's required as an investment in order to maintain their business operationally into the future. But so I guess my complaint would be that I think the debt is too high and I don't like how management frames it. It seems a little bit tricky on their part to use the EBITDA and almost try to hide the level of debt that they really have. But if anyone does know why they are using EBITDA, I would love to hear that because it just doesn't make the most sense to me. And, you know, my, I guess, reaction to that is that someone in management is trying to kind of hide that debt load a little bit or something like that, which I definitely don't like to see. Maybe that's not the case, but that's my perception at least. Moving on now to the dividends. Currently, Amcor is yielding about 5.5%, which is somewhat due to the significant decline in stock price over the past year. And their payout ratio is around 70%, which is a pretty solid amount that allows them to, deliver those dividends to shareholders, but still gives them plenty of room to reinvest their earnings back into the business to grow. They have been growing the dividend for 40 consecutive years, which is an awesome streak, and that really gives me confidence in management. But that streak is a little bit complicated. So Amcor wasn't exactly a public company before 2018, and they actually went public in 2018 and then acquired Bemis, which was another public company, to kind of create Amcor. So that's where the dividend streak comes from. But also for that reason, there's not really any solid data to look at for an actual 5-year dividend growth rate. But if we do look at the individual dividend growth rates over the past 3 years, they've been about 2% in each of the past 3 years, 2021, 2022, and 2020 as well. And they should be announcing another dividend increase at the beginning of this November. So I think it'll be interesting to see what they announce. Probably something around 2% if I had to guess. I think, there's a potential for them to announce more than that, but just because of how the business is struggling a little bit right now, probably not, anything in the double digits or something like that. So that's really something that I'm not too excited about from the dividend perspective is they have a little bit of a higher yield, which, is great, sure, but it's not really something that is a priority for me at this point. And pair that with the lower dividend growth rate, which is a priority for me, and the dividend is not super attractive. But on a related note, in terms of returning value to shareholders, Amcor did repurchase some shares in fiscal year 2023, which lots of people will applaud management for repurchasing shares, but oftentimes it seems like management is buying back those shares at pretty high prices. In the case of Amcor though, I think they did a good job of repurchasing shares at a relatively low average cost, as we can see from this chart here, close to $10 per share. And when we start to look at the valuation, this is where things get a little bit interesting. So when we first look at the price to earnings ratio, we see that the current PE is about 12.5, and that is significantly below their average PE of the last few years of around 21. This isn't, super insightful because of the short history as a public company under this particular ticker symbol, but it can give us a little bit of an idea and maybe point to the stock being sort of at an attractive price right now. We can also compare Amcor to their peers and see that the consumer cyclical sector's average PE is 15, and then also the packaging and containers industry average PE is 12.8. So in that regard, Amcor appears to be, about in line with their peers, maybe slightly undervalued compared to their peers when it comes to the price to earnings ratio. However, the story is completely different when we use a discounted cash flow model. From my DCF calculation, I calculated a fair value for Amcor stock of just under $5 per share, which is compared to the current share price of about $9 per share. So this is a pretty big red flag that says, Amcor is pretty much overvalued despite falling 17% in the last year. And not surprisingly to me, a big reason that the fair value is much lower than we'd expect is because of the high debt load. So when I do a DCF calculation, I find the present value of all of future cash flows, which in this case is about $13 billion, which is actually higher than the current market cap of the company. But then I adjust that for debt. So I subtracted off the $6 billion of net debt to get to that present value of about $7 billion, which would be the equivalent current market cap of the company in terms of a fair value. So that debt really affects the fair value calculation, and it's really not a big surprise because it seems like a large debt load for the size of the company that Amcor is. So as a whole, I'm really not the biggest fan of Amcor. I wish there was kind of a better way to put it, but I just don't think it's a great fit for me personally in my portfolio based on my goals. And in the case of this position, I think my emotions have kind of gotten the better of me. So I do own it in my portfolio. I initially bought it in 2020 when I really didn't know a ton about the company. And over the years, I've learned more about the company. And some of my big takeaways have been that I don't think they'll be able to grow nearly as quickly as they have over the past few years and as quickly as they say they will be able to grow. And also, they have quite a lot of debt, way too much for my liking. And then also, in terms of the dividend, they have a rather high yield currently, which is really not all that important to me. And like I said, the rate of growth of the dividend is fairly low, which is the important part of the dividend for me at this point. So a few things there that kind of add up to make it not the best company, I think, for me. Luckily for me, though, this is the smallest position in my portfolio. It's about less than 1%, I think, but it was kind of a stupid mistake. I probably should have moved past it, a year or two ago, but I just haven't, and I think that's kind of an emotional mistake, I would say. And right now, though, the issue is that I have plenty of cash on hand, so there's really not much reason for me to sell it, since I am getting regular dividends from the company, and I personally think the stock price is going to go up from where it is, at least to some degree. So I really don't see any reason to sell it now. At some point, hopefully, I will use up more of my cash and have a little bit less cash on hand, and at that point, that would probably be a good time for me to sell the stock so that I can raise the funds from that sale to reinvest back into other companies in the portfolio. As always, I would love to hear your guys' opinions about the company. Maybe I'm making too big of a deal about the debt. Maybe I'm being too fearful about the future. Like I said, they did grow earnings pretty quickly over the last 3 years, so maybe they can continue that growth beyond 2024. But personally, my feeling is just that they won't be able to do that. But if you think I'm wrong, please let me know. I would love to hear your thoughts. I really do appreciate y'all sticking around to the end of the video. It means a lot. Make sure to subscribe to the channel if you haven't already and join the free Discord server. And I will see you all in the next one.